Let's bring in Matt McLennan. He is the portfolio manager of First Eagle Funds. He is in the top 1% of his peers. And what makes Matt particularly interesting, he was born in Papua New Guinea. He grew up in Australia. And his #1 country right now is Japan. Hey, Matt, thanks for joining us.
Thank you. It's a pleasure.
All right, Matt, 5 of your top 10 names are in Japan. Why?
Well, I think when you look at Japan as a market, you have to understand it not through the prism of where you can make a quick amount of money in a short-term period of time, but how it provides you with the opportunity to find securities that embody a margin of safety. At First Eagle, we're always interested in first getting our money back, getting a real return on capital. And in Japan, a market that's been out of favor for 2 decades, there's an abundance of securities that trade at bargain prices, that have conservative balance sheets and long-term prudent management. And that provides a fertile fishing ground for conservative investors.
All right, give us a couple of the names so that people can try to relate to them.
When you look at what we own in Japan, we don't own the broader market per se. We own a collection of eclectic businesses that own either a narrow slice of the global economy or a royalty-like position in the domestic economy. And to give you an example, one of our biggest investments is a company called Fanuc. Fanuc controls over 60% of the control software for factory automation, be it in servo motors or robotics. So whether it's an automobile that's being manufactured or a fridge that's being manufactured, it's highly probable that Fanuc provides some of the equipment for that. They have no debt, net cash, and have bought back 20% of their stock over the last decade. On the other hand, we might own a more domestic business that is lower key in nature for the global investors, such as Nissin Foods, which has over 50% of the instant noodle market in Japan. Again, net cash, low multiple, and a long-term sustainable business model, and they bought back stock.
Hey, talk to us just about the obvious. Say at Toyota, you know, the production was hit so hard, so many issues for Toyota, and yet they've said that their car production is back. Any interest in a Toyota or a Honda?
We don't currently own either of those securities. When you look at what we own, whether it's the Fanuc in robotics and SMC, CNC servo motors, or SMC in pneumatics, or whether it's companies like Keyence in electrical sensors, we've tended to own the owners of the intellectual property that goes into factory automation. We're not betting on one automaker or the other. Obviously, at the right price, we'd be open-minded to owning one of those securities, but we haven't felt the need to do that at this point in time.
So how important is export growth for these companies in Japan you like, since Japan's growth is so minimal?
Well, if you look at the companies that we own, some of them are definitely global in nature. The Fanucs, the SMCs, the Keyences of the world, they sell their products around the world. And clearly, their ability to penetrate foreign markets has been a key driver of their organic growth historically. But I think one of the important things to understand about First Eagle is that when we make an investment, we like to go in at a price that does not assume growth. We like to get the growth for free. And so any growth that we get in the security investments that we've made in Japan is really going to be icing on the cake. An investment should make sense on the basis of the existing numbers, of the existing capital structure. That's what margin of safety investing is all about.
Where do you see the best growth in the world?
You know what? We don't have a view on where the best macro growth is going to be in the world. That's one of the areas where perhaps First Eagle differs from many people. We're not in the business of crystal ball gazing per se. What we try to do is focus on one security at a time, identifying individual businesses that are mispriced and have durable business models. When we do look to the macro, it's usually with an eye to what can go wrong. And we're very focused on the potential systemic risks that exist in the world. We call them fault lines, but we're less focused on thematically trying to identify the next great growth theme. Because in reality, there's limited correlation between macroeconomic growth and stock market returns. You're better off finding better in individual securities that are mispriced.
All right, Matt McLennan, portfolio manager at the First Eagle Funds. We appreciate your joining us. Interesting perspective we don't often get to hear. Thanks, Matt.
Thank you.